This is the Friday, December 9, 2022 installment of the Market Plus segment from Market to Market. Joining us again, Naomi Blohm, as we continue this show. Thank you for going with me on the little longer segment, but we still have a whole bunch of questions to cover. I started out with your trip to South Dakota. What else did I asked you specifically about wheat? What were the other questions you had from the audience?
Yeah, so they were primarily interested in, how long do bull market rallies last? Do they need to be worried about the interest rate inflation? If things fall apart, how low do they go? How long do they stay low? I think smart, longer-term planning questions, remembering lessons from 2012 and then the 7 years that we had bad prices after that. So just wanting to be on their game, but I think realizing that it might be here sooner than they think, that they have to just really be aware of everything coming at them.
Okay, good questions. How do you answer them? How does someone protect themselves for, we've been hearing about this since March, April, May, June, July, August. Oh, this recession's coming, this recession. Haven't seen it necessarily yet. Maybe we have and we just don't know it. How do you answer those questions?
Well, I think to what you had said to me the last time I was here, as we were talking behind the scenes, you made the point to me that people who retired are retired. They're not taking part-time jobs. So that is why we are still seeing, the jobs numbers, stayed good. And as long as people are working, we're going to be able to get through this inflation. And the first year that Mother Nature cooperates again, that's naturally going to bring the food price down. And that is what I think the feds are waiting and hoping for. So I don't know if the recession just comes and makes everything crash and burn, because again, we're low on workers. And I actually, when I was in Sioux Falls yesterday, there was a worker from the railroad, and I talked with him briefly, and he said that, they are facing shortage of, employees because people are going to be retiring. And so it's something that's affecting everywhere. It's going to be affecting agriculture as we see, farmers get ready to retire. So
well, yeah, it's like in that dairy question that we had in the program. I was just looking to see, if that was Adam's question. He was, the retirements have happened in that industry. It's going to happen in others.
Yeah, absolutely. So that's a factor.
I have other questions. Scott in Augusta, Wisconsin wants to know, why is soy meal on the board so strong? Should we be selling some beans in this mid-rally?
So the soybean meal is strong because of the unwinding of the soybean oil, soybean meal spread. So that's kind of its own beast, separate from other things. Now, the other reason soybean meal is starting to pick up pace and get some attention is because the Argentina crop is suffering. And even though the USDA did not admit it yet on paper, they will, give them another month. In Argentina, the world's biggest soybean oil exporter, soybean meal exporter, and the thought is that the U.S. is going to start to get some of that business. As far as should you be pricing your beans right now? Seasonally, what usually happens for soybean futures, the March contract, it'll kind of work a little bit higher into the new year, and then starting in January, it has a 2-week pullback. And then after that January USDA report, it works higher into February, and then it's over and done with by the February USDA report. So we're going to be, during that time frame, there'll be South American weather to talk about. There'll be our exports to continue to be watching. And was it a coincidence that China had a huge export purchase the day before the USDA report? So the demand is there. The demand is there. And the soybean story, I think, is friendly. So I would say you're going to want to be pricing your beans in February, but I would be okay to kind of hold off a little bit by then because it's still a friendly story.
I can't decide which way I want to play conspiracy theorist on you there. So if China buys the day before the report, isn't the USDA supposed to have their homework done before? That's another question. But say China does buy ahead of it. They're hedging their bets. It wouldn't be the first time China has all of a sudden canceled an order if they bought on a high.
Right, that's true.
If we would have fell to the floor.
That's true, but that's when all of a sudden it looks like there's going to be more supply coming down the road.
True.
I don't think we're going to see that necessarily unless we have perfect weather here in the United States, which with the drought that we have right now, it's going to take a lot to make it perfect.
And you'll get a chance to face your own comments in about 6 weeks when you're back.
Yes.
Post that next report that you're discussing, the big one there. Okay, speaking of winter, Tim in Iowa wants to know, are we in the winter doldrums price-wise for corn until spring?
Mixed answer. I would say this. Doldrums from the standpoint, I don't think corn prices can fall apart, because if they fall apart, all that's going to do is stimulate new demand, and we have tight carryout 1.2 billion bushels. At the same time, if prices go back up to the higher end of that range, and so the March contract, you're looking at $6.75 to $7 is the high end of that range, prices don't right now have a reason to go above that. So I think you're going to see range trading where now we're at the lower end. We're going to turn back around and go to the higher end. Like I said on the show, there's a strong seasonal tendency for March corn futures to work higher into January, and then capitalize on that with your cash sales at that time, because only if the weather is horrific in Brazil for the second crop corn, or if the weather stays not good here, is there going to be a reason for corn futures to go screaming back up to $8? Or if by chance soybeans went higher, it'll pull the corn with it. But doldrums, maybe so. Range trade, so make your cash sales when it gets to the higher end of the range.
Okay. I think about volatility and I think of doldrums. It seemed like we'd been in doldrums for quite a while, just on a lot of stuff. We've been very range, and then a little bit of volatility returns. Overall, what do you see in the next 6 weeks? More volatility, more doldrums in general?
I would say this, just remember that the more the market trades in a sideways pattern and consolidates, the bigger the breakout is down the road.
Okay.
So the doldrums are going to scream into volatility at some point.
That's gonna just boom.
Yes.
Gotcha.
Yes.
Okay. All right. Mike in Stillwater, Naomi, where is the greatest risk to mitigate going forward? Value, interest rates, weather, and last but not least, supply and demand.
The big three are supply, demand, because we have tight supplies right now. So Mother Nature and weather can fix that. And the interest rates, that's going to be a big factor for the next year. And the Fed, like I said, they are doing everything they can to make sure demand doesn't grow. I don't think they can make demand lessen, but they're trying to make it not grow, so that way we can continue to just keep supplies whole hum until we get Mother Nature to fix this in the summer.
Well, it ties into Phil's question. I was like, maybe we won't run Phil. Well, Phil, here's your question, because it's kind of tied to what she's saying. With Argentina hot and dry, but with Brazil weather more benign, is it likely soybean futures break $15 soon? Or will it take a weather issue in Brazil to make that happen? Could the all-time soybean price be in the crosshairs in 2023?
I feel like something's going to go haywire in Brazil. Not bad, because they're not having major struggles right now, but there's always some kind of a weather issue that'll show up in just a few weeks, because it's going to be, their summer. So something will happen. That'll get the market to work higher. $15 is resistance right now for the March contract. And if you look at how the charts are forming up, it's looking friendlier. And we're seeing strong demand here for the crush. That's only going to continue. We're seeing, strong demand for exports yet overall, and I feel like that will continue. So I do think we have the ability to have the market and those March beans go up towards the $16 level, but then that might be as good as it gets. And so don't store and ignore. Sell your product.
I was more on the that's as good as it gets, but I was going to say hoorah, or hooah, I won't say that. Let's close with this, because it ties to something we needed to get to and we didn't during the show. Bradley in Upland, Nebraska, who said it was pretty icy over there yesterday, but said, big shout out to Nebraska DOT. I know you thank the DOT for helping you get here, and you still have a ways to go, but he's asking, with high corn prices and declining crude oil prices, result in a decline in ethanol production?
Okay, so I was so glad that I saw this question when I got into Des Moines today, because I had time to look at it from a historical perspective. So right now we are using corn demand for ethanol as 5.275 billion bushels, okay? And that's with crude oil, between $75 and let's say $100, and we've got higher priced corn. So I went back and looked when crude oil was lower, which of course also coincided when corn was lower. So we had crude oil prices that were between like $50 and $70, corn prices in the $4 to $5 area, and our ethanol demand was stronger then than it is right now. So the ethanol story is a friendly story where demand for the past decade overall stays between like 5.1 and 5.3 on an average. So I don't think you're going to see demand for ethanol just fall apart if crude oil works lower. That it has been a kind of a constant story. So yay, ethanol.
Well, okay. Gas price, the story nationally this week, towards the end of the week, was, oh my goodness, gas prices have fallen. And then the next headline is, be careful what you wish for. As crude drops, I know they're not tied 100% together, 10%, 11% in a week, it could do it the next week. We saw how it can change.
Well, I think crude's going back up.
You do? How soon?
Absolutely. Oh, I think someone somewhere in the world is going to mess it all up within the next couple months. There's a big, strong seasonal push that it'll start working higher into first quarter, and then second quarter, and then it's over and done with by driving in the summertime.
Yeah.
So I feel like we're going to go back and see close to $100 crude oil, and then it'll kind of simmer down again. So I feel like corn prices follow. Ethanol demand should be there. The biofuel thing, that still is a friendly story for the long term, even though the EPA numbers weren't quite as fantastic as what people wanted. They couldn't make it as fantastic as people wanted because that would just make the markets freak out and prices go too high or too soon. So when you think about it, I read that California by 2030 is supposed to triple the amount of renewable diesel and biodiesel that they're going to be using. Triple the amount is huge, along with all their little electric cars that they're going to be happening. So the demand is there for our products. I only think for the soybean story, it's going to grow. The USDA has not really put that on reports yet. That'll come out in the upcoming years. So the demand is there. The competition for acres is going to come this spring because we're going to need to make sure we have more soybean acres to meet this future demand. So friendly story.
Got you to end with a smile.
Absolutely.
All right. Naomi, thank you so much.
Yeah.
Appreciate it.
Thank you.
It's Naomi Blohm. Thank her for her time. And next week, we're going to look at another effort to change overseas shipping patterns from major ports to the Great Lakes. And Ted Seifried gets to analyze the commodity markets. Thank you so much for joining us, and have a great week.